All right, hello economics students. So the notorious Unit 3, Outcome 3. We are going to be so good at this by the end of the video. First thing I want to start off with, we'll get to some content in a moment, but the first thing I want to start off with was the difference between a cause and an effect question, and just making sure that you're answering the exact question that you're getting. Okay, for some reason we struggle with this on this particular area of study. So is the question asking you about the cause of an increase in the terms of trade? Well, then you should be focusing on it's the supply shock in Brazil, or maybe the increase in demand from China. Is it asking you about the cause of a depreciating dollar? One of the factors that determine the exchange rate. Is it asking you about the cause of an increase in the current account surplus? Again, one of the factors could be an increase in economic growth as it just starts raining here. So if the question is asking you about the cause, you should be focusing on this blue section here. Okay, there are some examples of the questions that you might get that are asking you to explain the cause. On the other side, if you get asked a question about the effect, what's the effect of an increase in the terms of trade? Obviously, that impacts national income. It impacts aggregate demand. It impacts the exchange rate. What's the effect of a depreciating Australian dollar? Well, a change in aggregate demand, a change in aggregate supply, therefore an effect on all three goals. Okay, and you can start to build out some of the questions you might get just from this little table here. This is not so good, but what's the effect of a decrease in the current account surplus? Well, it could affect net foreign debt and our goals. So if you get questions about the effect, you should be focusing on the future. The cause is in the past, the effect is in the future. And there's some examples of the effect questions that you might get. The next thing is the difference between a theoretical question. So what might be one factor that leads to an increase in the terms of trade? And what was one factor that led to a decrease in the terms of trade in 2020? So use your reading time to find these. But if you get a could or might, that's a theoretical question. So you could use any factor. It doesn't matter. If you get one that refers you to a specific period or outline one factor that did lead to this, or you need to use what actually happened in the economy over that period. Okay, I would just use what actually happened over the economy in that period for both. But if you're stuck, you can just think of something theoretical. Factors are really important. So when you get asked a question about factors, you should be focusing on the factors from your study design. I put this here because it's mostly difficult in this area of study, but you should be talking about the factors that determine demand and supply, the factors that determine elasticity, the factors of AD and AS. We're going to do the factors that determine the exchange rate. So when you get asked about a factor, it has to be something from your study design. You can't make it up. Okay, so let's get into the actual content here that's tricky. Remember the balance of payments, these two accounts that balance each other out. Basically, they're showing transactions over a period of time. So it's a snapshot of all transactions that took place in this period between Australia and the rest of the world. Okay, and we look at those transactions in net terms. So remember, credits is when money comes into Australia and debits is when money leaves Australia. And we always record things on the balance of payments, or we record the balance of payments in net terms. So the difference between the two, or net. We have one side called the current account, which is one-off transactions. Basically, when we sell goods overseas, when we trade, or when we receive or send income overseas, and the CAFA, which is change in ownership of assets and liabilities. You know that, but just a little refresher. It's important because when you're answering balance of payments questions, you always need to refer to these three things. You always need to refer to the sub-account. So is it net goods, net services, net primary incomes, net secondary incomes, maybe? I doubt it. Then what happens on that account? Is there an increase or decrease in credits, or is there an increase and decrease in debits? And then the overall impact. So what happens to the current account surplus? Does it increase or decrease? Because remember, we do have a current account surplus at the moment. So you should always be referring to that. Here's a past exam question, which kind of ties a couple of these concepts in that I've just been talking about. So it says, referring to the graph above, outline one factor that might explain the trend in Australia's current account balance. So first things first, the trend is not that clear. So I actually think that you could go either way. So you could say, you know what, the trend's going up, the current account balance is improving as a percentage of GDP, or it's deteriorating, or it's getting worse as a percentage of GDP. This is one of those questions. Remember, VCA doesn't know what the current account balance, or any data for that matter, is going to be. So it just gets printed into your exam. So if the trend is not clear, don't freak out, don't waste time. Draw your line of best fit and just write your answers as per whatever you've decided to do. Okay. The other thing about this question is that it says outline one factor. So we need to use a factor, essentially an aggregate demand factor or an aggregate supply factor, that's going to improve the current account balance or worsen it, depending on which way you went. So a factor is not net goods increasing. A factor is not the trade balance. I'm sorry, I was looking at the wrong graph there, wasn't I? I should have been looking at this dotted line here, but it's about the same. A factor is not an increase in credits or a decrease in debits. A factor is an increase in economic growth or a decrease in economic growth or something like that. Okay. So how I would mark this is outline the factor. An increase in economic growth overseas leads to an increase in demand for our goods and services. Then we need to explain how it impacts the sub-account. So this would improve net goods and net services or net goods, as there'd be an increase in credits. Maybe, depending on what factor you choose, it might impact debits. And then link it back to the overall impact, or in this case, link it back to the trend that you chose. All right, the terms of trade, another really difficult area of study, or dot point. We're really just focusing on price. You need to ignore everything else, okay? So we're thinking about export prices versus import prices. And I guess it's important to remember that they've already been paid and they've already been received, okay? So when the terms of trade comes in on the ABS, we've already received that high export price. So you want to ignore volume. The big factor that's driving the terms of trade, and this is where I would use this theoretically or actually, depending on the question you get, is the supply shock in the supply shock in Brazil, which has led to an increase in prices of our iron ore. That's your factor. Or, even though it was a couple of years ago, or just an increase in demand from China, which is driving prices. Okay, I would use the first one. So one of the common mistakes we make with the terms of trade is that we don't understand that the prices have already been received. So terms of trade is in fact an AD or an AS factor. We can use it as an AD or AS factor, but prices have already been received. If we've got an improvement in the terms of trade, we've already received higher prices for the terms of trade, which means there's going to be an increase in our national income because we assume volumes stay the same. We don't think about volumes, but the price received is higher. Therefore, we receive more income from overseas. That's a good thing for aggregate demand. You could think about it as an AS factor, but I think AD makes more sense. Okay, and vice versa. If there's a decrease in the terms of trade, then we've already received less for our exports or paid more for our imports, remember, and that's a decrease in national income. Okay, so don't make the mistake of saying, the terms of trade has increased, which means the price of exports have gone up. That will decrease X, and that will decrease AD. That's a common mistake. Don't make that one. Here's a little snippet from the newspaper just to remind you of how this works. You know, over the year, there's been a huge increase in the price of iron ore, and the terms of trade has sort of reflected that. Australian companies have received huge prices or an increase in prices for the iron ore that they sell, Fortescue Metals, BHP, those sorts of companies. And it says iron ore $60 billion dividend wave lifts all boats. Remember, that's sort of one of the ways that an increase in prices of exports gets fed back into the Australian economy because a lot of Australians own these companies, so there's an increase in dividends. So that's how the injection works. Another common mistake with the terms of trade is the balance of payments. So again, we forget that it's already been received, the price. So how does an improvement in the terms of trade impact the balance of payments? Well, we would assume, remember that X or the credits is basically a function of prices times quantity. Now, if we assume the quantity stays the same, then we're going to increase the price, then that's going to increase the credits. Yeah. So we assume volumes stay the same. If the price goes up, well, then we increase the credits on net goods and net services. How does it affect the exchange rate? Another big mistake that we make, like I sort of mentioned before, is we say, well, the terms of trade is increased, therefore less demand for exports, therefore less demand for AUD. I think that's not the route you want to take. And so we just think simply that if the terms of trade improves, then foreigners now need to exchange more of their currency. So they need to demand more AUD to buy the same basket of goods and services. So therefore, an appreciation in the dollar. So really an improvement in the terms of trade is good on all fronts, except the aggregate supply, which we didn't really do. So it's good for aggregate demand and national income. It improves the balance of payments. It's going to increase the surplus due to more credits. It's going to appreciate the dollar. Well, that's not necessarily a good thing. What I should say is it has a positive relationship. Okay, so it has a positive relationship. Just trying to think of easy ways to remember it. Okay, so the exchange rate, really we should be thinking this as a micro market. Okay, it's just the market for Australian dollars. So it's determined by demand and supply, and demand is when money comes into Australia and supply is when money leaves Australia. But here is the factors. So remember, you can't say, The reason the exchange rate is appreciated, the factor is an increase in demand. That's not a factor. What caused the demand to increase is the factor. So here are our factors: relative interest rates, which drive capital flows, demand for exports and imports, and so on. And you can see the terms of trade is a factor there. Finally, trade liberalisation. So remember, it's about removing barriers to trade, opening up our local businesses to competition. So removing tariffs and subsidies, etc. Now, it's really important to remember there's different impacts here. And if you get asked about different impacts in the short term and long term, and if you get asked about trade liberalisation, then you should think about short term, and you should write about short term and long term and know that they're different. So let's have a look. So in the short term, remember, some firms may not be able to compete. I always ask you to think about Holden. When they got open to competition from the rest of the world, they could no longer compete. So some firms will shut down in the short term. This is the real sort of Donald Trump argument. And that's going to lead to some job losses, to lead to some business shutdowns, and it might hurt economic growth and full employment in the short term. And it could put downward pressure on prices, okay? Primarily sort of the aggregate demand impacts. In the longer term, as we start to improve and we adapt and become more efficient, our business sector that is, it's effectively an increase in the capacity of the economy, because we're going to be improving productivity, improving the quality and quantity of our resources. So it's just like an aggregate supply argument. It improves our international competitiveness and allows us to achieve all three goals in the long term. Okay, primarily aggregate supply impacts there. So just remember, short term, long term, very different for trade liberalisation. All right, that was a whirlwind tour of Unit 3, Outcome 3. Hopefully that helps you and makes things a little bit easier. I'll see you in the next video.